Lindsey, I want to go to you very quickly because you were expecting the lowest number, 125,000. It was still quite a bit above the number that we got.
I think the market should actually look at this as a pretty positive report because it's going to be another data point that's going to make it very difficult for the Fed to ignore the weakness bubbling underneath the surface, which means that the Fed is likely going to have to act by the end of the year and give us the cycle's first rate cut. And we've seen this ongoing disconnect between the market's plea for a rate cut or rate cuts in the near term and the Fed consistently digging in their heels that they're opposed to any change in appropriate policy. I do think this is another data point that forces the Fed's hand.
All right, I just want to take a look. We were just looking at the 10-year. For those of you who are at home listening on radio or in the car, you can't see that, but the 10-year is now yielding 2.07%. Or 2.081%. That it was above 2.1% this morning. So, Steve, a real quick reaction here in the markets on this. What are you digging into with the numbers that we haven't talked about?
Not much to dig into. What I'm digging into are the revisions and the current one, which tells you that there has been. Honestly, Zandy has come on and been singing this same song for a while, and he's been wrong until now he's right, which is a downshift in the jobs market. I think that you look at the 3-month average being 151,000. And had those other numbers been input into the models that are out there, they all would have been for a lower estimate had we known that it was a little bit weaker before. So the net is what tells you that there's this downshift. We don't know if any of it's trade related. It's what I said at the top of the, you got these two forces going on. You know the economy is weakening, slowing with the expectation that it's not going to be slow. The idea that it was going to be somewhere in the 2% range or a little bit above was where we thought we were going to. And then you layer in the trade thing, and maybe now you're a little bit weaker, too,
What
as
was
well.
Private sector growth versus government?
It was 90. So somehow government found a way to lose.
Net 15,000.
Net 15,000 down. I'm just looking at the data right now. I'll get back to you on that, Becky.
Hey, Rick, let's just talk about the market's reaction to this. Dow futures came down a little bit. We'd been up about 75 points above fair value. Now we're up by about 50 points above fair value. But the yield in the 10-year really is something worth watching. What else are you seeing in the Treasury market?
Treasuries are yawning through it. I think there's two big tells here, actually. One of them is Fed fund futures. They are rallying, and the farther back you go, because it's the logjam process of the contract, of course, some of these months now, like November, they're up over 5 ticks, which is rather substantial. But I caution viewers, think about it just like a bunch of logs going over the cliff. The current log is the next meeting. Maybe 20% and maybe gone up a little bit. All the other logs behind it are showing obviously much more easing. The problem with the contract is the accuracy we all talk about is really only for the next log. And all the logs down the line, as they start to come forward and contracts expire, many times you get a much sharper image of reality. So I do caution, but it is still a tell. You can see what investors are thinking. The other big tell is that the dollar index lost about 1/4 cent quick. It was virtually unchanged. It's now down 1/3 cent. I find that a very large tell with respect to, we have hindsight now of other central banks that have eased. We have Mario Draghi, praying to the gods that we can maybe get a little more inflation, but not even thinking about raising rates till, mid-2020. So I think the dollar index is a very good gauge, and it's obviously pricing in kind of the story Lindsey's been talking about, at least for the moment.
Not only that, but if we do see big moves in the dollar, if it weakens a little bit, Jason, I guess the question is, what does that mean in a broader context when you start talking about the potential for tariffs coming on next week? We had kind of said it's not going to matter because the peso had weakened so much against the dollar. The dollar has a lot of implications through a lot of different things that could be happening here. Jace?
Yeah, I think it certainly does. It's what insulates you from some of the dumb decisions you might otherwise make on things like tariffs. But it just doesn't change those supply chains and the uncertainty of those products that are moving back and forth across the Mexican border. Why would you want to make cars in America when you could make cars in Japan, Germany, and have much more reliable supply chains? This jobs number itself, by the way, I don't think there's anything to worry about there. But anyone who's worried about inflation right now in a world where nominal wage growth is actually slowing, it was only 3.1% over the last 12 months. Just a few months ago, it was at a 3.4% pace. There is no reason at all to be worried about inflation being too high. There's reasons to worry about inflation being too low. So I think this gives, not a necessity of the Fed acting, but a lot of permission for them to act without worry.
David?
So over on the policy side, I think this is a big signal to the White House and the administration. They've got to find some new tools for economic stimulus, and that the tariffs are now higher risk, essentially, because they're starting to have an impact potentially on growth and the numbers there. So I think you'll see more push to get the deregulatory measures out and hopefully some cautioning on imposing these new tariffs.
Two-year note yield down below 1.8, so that's also very sensitive to Fed expectations. And so it's not too far below the range. I mean, I was saying before we got the number that it was surprising in a way that the Treasury yields went into this number at their recent lows just about, and it showed you that the bond market kind of sniffed out it was probably going to be a little bit of a light number. But it doesn't change the story that radically from what I think the market was handicapping in terms of Fed intentions. Maybe just solidifies that view a little more.
Beck, I just want to give you some of the detail here. The construction and manufacturing being down. Maybe some of the weather with the flooding and stuff like that with construction, but the manufacturing is something Lindsey was asking for. It's been fairly, tepid, 3,000, 5,000. Retail has been on this torrid decline, -7, -13, -14, and that could be this secular thing that's going on with the bricks and mortar shops.
Those were the same areas we saw weakness with ADP earlier this
ADP did a wonderful job of leading you to this weakness,
but
as much as it is otherwise maligned.
One question I have with retail is, look, Americans are still spending. That retail number is not necessarily a reflection of consumer spending coming down.
Absolutely.
And we're spending our money in different ways, getting things in different ways. And I'm not sure that the jobs number is going to pick up additions in an Amazon warehouse, or at least not put it back in the same context.
There's been this ongoing discussion between the retail industry and the government data people about what counts as retail hiring.
Right.
And we have been looking for some of that retail hiring in the transportation and warehouse segment. That an Amazon worker is a retail worker at a warehouse rather than at a clerk at a bricks and mortar store. You've had some additional strength in there, but not necessarily this month. And again, Mike did on the fly, did the math right, -15 on government.